Hey, welcome to Make Your Money Matter. I'm your host, Brad Barrett. Our goal, as always on our show, is aiming to help you create a better relationship with your money. And I want to talk about something that's actually come up with some of our clients recently. And it's about how parents, all of us as parents, right, can help kids become first-time homebuyers. This also pertains to you as the kid, if you're watching as well, if you're listening here, for some conversation starters, if you will, that you can have with your parents. Look, real estate prices are up all over the place, right? Interest rates are obviously crazy high. So it makes it challenging for our clients that are in the younger generation to buy homes, and more on that today. But before we get started, make sure to smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. And look, we're in an era right now of high real estate prices and high interest rates. Not a great combination, right? And all of this is making buying a first home more challenging. But I want to share something that I share with our clients. Often parents, like family members, can help our kids become first-time homebuyers with ways that they don't even realize, right? They can make loans to them, they can give gifts to them, they become cosigners. I'm gonna go through these ways here that I think to some may be out of the box, but they're really important. I use them all the time as a financial advisor. I have many success stories of both kids who are trying to figure it out, ask their parents or grandparents, and vice versa, working with the parents and grandparents to help the children. The first one I want to bring up is something called an intrafamily loan. So one strategy here that I talk to clients about all the time is just having the conversation, okay? There might be a grandparent, there might be a parent who's sitting on some cash, maybe earning 2, 3, 4%, hopefully right now in high yield accounts, but they may not need it, right? It's not a part of their overall retirement strategy, and they would actually rather deploy it to a child or a family member to use as an intrafamily loan. It wouldn't be a gift, friends, if it's constructed as a loan to your child or family member to help them as a down payment. And by serving as their lender, if you will, you can alleviate the burden of them having to meet all of the asset and income requirements that banks will typically require. I think it's important to note that we're only like 120 some years from when the original mortgages were done by banks at the turn of the century in 1900. We were still doing loans through interfamily stuff. If someone wanted to buy a piece of land, it was done through the family. Banks didn't really come in to the mortgage business until the early 1900s. So this is not like it's some foreign thing I'm bringing up here. This is actually how America was born in terms of its growth from a real estate perspective to help family members grow wealth. So I want to be clear here. In order to avoid the gift tax implications, parents or family members should formalize the loan with a simple promissory note, and you want to charge a minimum interest rate. And that rate is actually called the applicable federal rate, the AFR rate. You can look that up. Now, the interest rate is dependent on the length of the note, and it's published by the IRS monthly. So you can look it up, the AFR rate, you can see what the rate is and what you should charge. Now, once the note is signed, the same interest rate applies for the duration of the note, even if the AFR is changed thereafter. That's something we get asked all the time. So look into that and talk with your estate planning attorney and CPA and how that works for your family. The second thing I want to bring up is actually using the intrafamily loan in another way. So another helpful way parents could help for down payments or helping children or family members become a first-time home buyer is by using this intrafamily loan strategy by strategically funding it when it's needed. So a borrower on a mortgage who does not put down a 20% down payment would likely be required to purchase mortgage insurance. So some strategies I've used with clients to get around this, by the way, mortgage insurance can be pretty significant, right? It can be costly depending on a number of factors, but it can be high. So rather than the child incurring that additional fee, the parent could issue an intrafamily note or loan for the gap amount in the down payment. So sometimes even if the child has the adequate assets, for example, so this is like right off number one, right? If they don't have the income or don't have the assets, you can do straight intrafamily loan for the down payment. This one is kind of a subsection of that where you might have the assets for the down payment, for example, but they wish to retain more cash on hand, the child does, right? Maybe to do some upgrades for the house or furnish it. And they can use this intrafamily loan to bridge the gap. The child can use the cash instead to make, future mortgage payments as opposed to paying the insurance premium or things like that. This strategy helps optimize and really manage expenses from the perspective of the entire family unit and keeps the child financially engaged as well as responsible. Now, I think it's important to note when it comes to the tax consequences, as always, you should talk with your CPA, but it's important, as my experience has been, this is for the parent and the child, right? Or the family member that's loaning it. As the lender, you, the lender, you would have to report income on the interest earned on the note. Now, often this amount is pretty minimal and acceptable for most parties, but it's important to make sure you bring that up with the CPA. But the child, conversely, as the borrower, may also be able to claim the deduction for the interest rate. So that's really cool. So it's important to essentially know these strategies that I want to bring up. And the third one I want to bring up is an outright gift. So other than the intrafamily loan scenarios, the third one is a gift, right? And then family members can do this over time. They wish to, simply give their children the money toward the home. I've had some clients, have this happen. Now, if so, in this case, parents or family members can utilize another gifting strategy called the annual exclusion gift. So each year, an individual currently may give up to the annual gift tax exclusion amount to any individual without tax consequences. Currently, that amount is $17,000 per year. And by the way, if it's left unused, it cannot be carried over to the following year. That's important to note right now. The amount is available for each recipient too. So $17,000 per recipient. So if you have multiple kids, you can give per kid and it can be used as an outright gift or again, in the form of a loan forgiveness. Now, family members can also choose to forgive some of the principal of the note over time by either utilizing the balance of the annual exclusion gift yearly or for larger amounts, a lifetime gift exemption. Again, talk with your estate planning attorney or your CPA. So again, making this very clear, talking with counsel is of utmost importance. And this fourth one as well, I want to bring up is just a cosigner. A common way for family members or parents to assist is to actually act as a guarantor or a cosigner on a loan, which allows the parent to help a child who may not have established credit, for example. Now, in some cases, it may also help them secure better terms on the loan. With this strategy, obviously there will not be immediate monetary outlay from the parent, but should the child fail to make timely payments, the parent could be contractually obligated on the terms of the loan. So you want to check that out. Okay. And again, this is the type of indirect financial benefit versus direct benefit, which may have some income and tax gift implications. So again, talk with your CPA, but as always, I bring these up because these are 4 ways of being a cosigner on a loan, just providing a gift of money to a child using an intrafamily loan. In other ways, or using an intrafamily loan as a down payment, or maybe even bridging the gap. These are all great ways to help a family member who might be struggling to get into, let's say, a first-time home, or just buy a new home in this new age that we're in. So I wanted to share that from experience working with clients, working with their kids, and I hope you enjoyed that today. If you did, make sure to subscribe to our show so you don't miss a single episode. And always remember to make your money matter.